All right.
Okay. Hello, everyone.
Hello. We are live. Welcome, everyone. Welcome. Today we have Deb Kennedy back by popular demand. Like, hello. Today we're kind of doing a continuation, hey, Deb, of last week. We're going to be doing more, I'll review in a minute. Once people start jumping on, I'll review what we talked about last week a little bit. But, these motivated sellers that are coming up that we're going to start seeing these major opportunities for, and maybe even in the last week you've talked to a few more even.
I have.
You have? Yeah, I believe it. People are saying, hey, welcome back. Say hi as you come on, you guys. This week the feed seems to be working, so yay, I'm excited. This is a hot topic. A lot of people need to know creative strategies that are coming up. There's going to be a lot of people that need to get out of their properties. Maybe they don't have work. Maybe, even like, it's sad to say, but I've noticed an increase in divorces already, or separations from people that have been calling me just for renting of our furnished units. We're going to have these opportunities, right? So it's going to be a continuation. Hey, guys. George, you're the sweetest person. He says Deb got her arm twisted.
How did he know?
All you have to say to Deb is that people need you. And as soon as you say that, she can't say no. So it's terrible. Yeah. I know you're Achilles' heel.
A little bit of a sucker with that one, for sure.
Yeah, that's awesome. Hey, Leona and Mike, Daphne, Gary, yay! Megan and Yenga. So Rochelle, welcome everybody. Aurora, welcome. A new name that I knew. Camilla. Hey guys. Okay, so we got some great stuff. Greg, yay! I need to talk to you, buddy. So good to see you. And you're a newbie in this too, hey Faith. So welcome to all of our new members. We have 18 new members this week. So welcome everybody. I'll just introduce myself. So I am Tiffany. I am part of the Corey and Tiffany Young team. We are founders of Investor Life. We help investors take their portfolios from 2 or 3 properties up to 15, 20, 50, whatever it is that you want, by helping you learn how to find and talk to joint venture partners, how to raise money, basically. So that's who I am. We have a special guest on today. Deb Kennedy is an investor. She's one of our Ignited members in our mentorship program, and she is amazingly only 5 years into her investing, but has found a stream and a system of finding motivated sellers. And those motivated sellers coming to her now saying, I have this property. We talked last week all about that. So Deb from Mountain Edge, yes?
Yes.
And so now, once we have these properties and we have these people coming to us and saying, here's a property, I need out, help me. Now what, right, Deb? Now you got to figure out how to help them, right?
For sure. Yeah. So that's where the conversation begins, for sure. And I think last week we kind of talked about, people are often very anxious when they first call me, or if they emailed me when I first called them. So I just get them talking about their house, something relatively neutral first. And then we start talking about the nitty gritty of, okay, so, if you don't mind me asking, why are you selling at this point in time?
Yeah, I loved that. So for those of you, hey, Jeff and Jose, Mel, hey, everyone, and Tina. So just to recap a little bit from last week, you've found some systems, you have some ways of getting word out there to people that you're buying houses, that you're available to purchase, but you often first need to pause on the business side of things and talk to them as a human, right?
Definitely. It really helps if you can make some kind of connection with them. It can be anything. Definitely, it's way better if it's coming from a genuine place. So maybe we're both parents, maybe we're both connected to tradespeople, something that we genuinely connect on.
Yeah, That's good. And I love how you said that you start asking questions about really normal everyday things just until you kind of have a rapport with them. And then you ask questions about their house, their home, their situation, because like you said, many times they're coming to you in with anxiousness. They're in financially not the best place and they're embarrassed. So they need someone that they know is on their side and is really going to try and find something that actually helps them.
Yep. And some people are really scared about the scams that are out there. So part of the reason I'm trying to connect with them is the same as what we would do with an investor to grow that know, like, and trust factor. I want them to, hear me as a real human being. I'm not trying to scam anybody. Each side is going to be working with lawyers. So from the very beginning, I'm trying to grow that connection of this is a safe thing to do, even though it's outside the box.
So, the question is, once they do call you and now you have to talk to them. So I just wanted to go over a couple of the main kind of solutions that you end up offering. So last week we talked about some of the situations that you see and some things that, we can watch for, and inherited properties, some divorces, whatever it might be. Now, what scenarios do you end up usually thinking about or talking to them about in a motivated seller scenario?
So my favorite strategy is agreement for sale. Is that the question that you're asking? Okay.
Yeah.
So
what's the agreement for sale?
So an agreement for sale, basically I am taking on the mortgage, the taxes, the insurance, all of the property management, all of the maintenance costs, and I become responsible for the entire balance of the mortgage as of the day where we take possession on the property. So basically the seller has zero expenses left to pay on the property. They're out of every financial obligation, and it's done with a lawyer for the seller and a lawyer for the buyer. So there's no funny business.
Yes, fantastic. And do you often tell them that? Do you often say up front, we both use lawyers for this?
Absolutely, yeah. So just for people who don't know me, I live in the greater Calgary area. So Calgary and Alberta right now, there's a lot of people who can't afford a realtor, but sometimes there's a realtor involved as well. That's not a problem. We can work with them. But the key for me to build credibility is each party has a lawyer representing just them. So my lawyer won't convince you of anything. You have your own lawyer representing your own interests.
And as the motivated seller, do I pick my lawyer or do you give me that lawyer?
In my perfect dream world, I would like to give you a list of lawyers that are familiar with agreement for sale, because that old adage of a confused mind says no works just as well for lawyers as it does for sellers. So if I'm sending my seller to a lawyer who's like, oh yeah, I remember this from law school 15 years ago, but I haven't seen one, the deal's probably going to fall through.
Yeah, beautiful. Okay, love it. And I like that you say I'll give you a list of sellers. So let's break down the agreement for sale. So we're going to talk about vendor takebacks a little bit as well, and some of the more common exit strategies that we can offer to people that are needing to get out without a realtor, without paying fees. There's maybe very little, if any, equity inside these properties. So you're taking over all the expenses, the property management, you're taking over all the problems. So do they still live in the house?
No, so they will have to move out, but they will have no headaches related to the house. They will have no bills related to the house. They are generally responsible for paying their own legal fee. But other than that, sometimes there's very little expenses for them to get out.
Okay, so is it just considered like a sale, or why do we have a contract or a term agreement for sale?
Okay, good question. Yeah. So basically, there's two pieces of paper that normally go with the agreement for sale. And so part of the way that I build credibility with my sellers is I say, we're going to use exactly the same contract that you would use if you were working with a regular sale and a regular realtor. And then we're going to add one page for financing. Now, in reality, there's a third piece of paper because I would like to get power of attorney on that property as well, just so that I can do renovations or anything down the road. But when I'm talking to sellers, it's the regular real estate contract from whatever province you're in and one extra page that explains and clarifies in a legal contract all of the financing details.
Lovely. Okay. So that's great. So I love that by saying to them, no, it's the normal contract that you would use anyway if you were selling your house. So the idea is that they will continue to hold the mortgage for you then. So there's no qualifying for you, is there?
That's right. It's seller financing in the sense that they hold the mortgage and they stay on title. I often get questions of, well, why do I have to stay on title? I have no problem with the mortgage, but I don't want to be on title. Most of the mortgage lenders would like to see the name on the mortgage match the name on the title. So that's why we do it that way.
Yeah, perfect. So the beauty of an agreement for sale, I'm just looking here, there's a couple questions. And if you guys have questions, throw them in the feed and we'll try to answer as many of them as we can get to. And if we don't get to all of them, we'll come back and answer them later on after we get off live. So, but it looks like one question was, do we need to use two lawyers?
Yes.
Okay. And it's always good to, when you're talking to a seller, to be able to say that. I know that from my own experience. It's always good to be able to say that. And that how to be real and not a scam in their view. So you mentioned having two lawyers. I love the part about using a normal contract. Any other tips there that kind of helps to alleviate their fears a little bit?
So one of the things I've started explaining to people is that if we were talking about a multifamily, like an apartment building, if we were talking about a commercial property, seller financing is normal in that world. But in residential, like normal house sales, it's a little bit outside the box. So we're not doing anything illegal. There's nothing unethical about it. We're just taking a strategy that's normal with the bigger real estate players, and we're bringing it down to use it on a single house because it could help the seller in whatever situation they're in.
Nice and clear, really simple to understand. Yeah, I really like that. So there you go, Dia. There's a couple more things for you. If you have, so Paula says they hold the mortgage and stay on title. Who is they? If they're the sellers, yes. Then where are they moving out?
So it could be any number of reasons. So the case that I'm working, or the property that I'm working on for this week, one person is moving out of province, one person is moving into an inherited house, and the only thing left in the house that we're talking about with this couple that's divorcing is bad memories. Neither of them want to spend one more minute there.
Yeah, right? It's so... Yep. And Paula, last week we did a whole training with Deb on some of the typical scenarios that come up. And then if you watch that, then when you're out talking to motivated, vendors in your area, even just around the water cooler, or just at the grocery store, your friends, you'll start to recognize certain patterns that come along, and you'll start to recognize, oh, this is one of the ones that Deb said can often turn into someone that's motivated is usually willing, because there's not a lot of money in there for them and they don't want to wreck their credit. They're usually willing to participate in creative terms, right? That's essentially what we're talking about, is terms.
Exactly, yeah. So just because it makes it easier to talk about real deals sometimes, the story that I'm working on this week, so it's a divorcing couple moving to separate places. They have a fabulous house, fabulous location. They had the house listed with a realtor. They got an offer. And then when it got down to, I don't know, like the 75th percentile of we're almost done, the bank said, wait, you have a prepayment penalty of about $25,000. Then they would have had realtor fees of $15,000, and there was maybe only $10,000 of equity in the house. So they would have been literally out of pocket $30,000 to get that house sold.
Just to get out from the monthly expenses and responsibilities associated with that home, they would have been 30 grand out of pocket.
Yeah. So hence they called me.
Okay. And what kind of scenario are you thinking will work for them? And I'm sure you're getting a lot of these calls lately. So what kind of scenario are you thinking to employ for them?
Well, this is a really sweet deal for me in the sense that, so the wife in this case is moving into an inherited house. She doesn't need to qualify for a mortgage. The husband in this case is moving somewhere else, and he doesn't care if he ever gets a mortgage again. He's in that kind of a bad place right now. So neither one of them need to be able to qualify for a mortgage in the future. So I really like this one for agreement for sale. I can't buy it very much below today's market value. So that's a bit of a risk for me. But if I have time, so if I have that deal for 5 years, I can do a lot of things with that property for 5 years to create a great investment property.
Nice. Okay. So you're going to make an agreement that says, listen, I'll take over the responsibility, the expenses, the property management, the maintenance. I'll take all of that as of, next month, June 2020. But I won't officially buy it from you until June 2025, let's say.
That's right. So in this type of deal, so normally you'd have your possession date and it's a done deal, right? So in an agreement for sale, you have a possession date. So that's the date I take over all the financing and I can do whatever I want with the property. And then there's a maturity date. So that's the date that the deal is done and the seller comes off title and off mortgage. So on the drop dead date or whatever of June 2025, I have to find a solution to pay out whatever the balance of the mortgage is.
Gotcha. Okay. So, so just to kind of, reiterate, you're going for as long of a deal as possible on this. Yeah.
Yes.
And that's going to give you more time to have the market go up, have the mortgage continue to be paid down, and, maybe renovate, add some value that way, that kind of stuff, right?
For sure. So, and just to be clear, like from the investor side of things, all the mortgage pay down is mine. All of the cash flow is mine, and any appreciation or depreciation is mine. So some people will often ask right now, what if the market goes down? Am I suddenly going to get this house back? And I explain, no, the risk is mine. I'm taking on this risk by using this seller financing strategy.
Okay. And that's a really important point. Thank you for clarifying that. It's the appreciation is yours, but the depreciation is also yours should that happen.
That's right. Yeah.
Awesome. So Terry, we kind of covered it already. She asked this a minute ago, so she's probably heard the answer now, but what's the typical term for this strategy? So would you say 5 years is typical?
If it was me doing the deal, I would always shoot for a minimum of 5 years. If I can get 7 to 10, I'm really happy.
All right. Awesome. And then what happens at the end of the term?
So at the end of the term, one way or another, I have to pay off the balance of the mortgage and get them off title and off mortgage. So I can rent to own it, and the rent to own tenant buyer can get their own mortgage and pay it out. I can sell it, like just literally put it on the market 5 years from now. If the mortgage has shrunk to a small enough number, or I have enough people with RRSPs, we could look at RRSP financing on the property. I have to figure out something. Maybe I even bring in a joint venture partner at only 60 to 70% in 5 years. Whatever I do at the exit, I just have to find a way to pay off that mortgage. But I have multiple options.
Yeah. And I love how you're saying, I have to find a way to pay off that mortgage. because that really is, you know, from an investment point of view, that really is what you have to think about. Like if you know, make money along the way, cash flow and everything else, but your ultimate goal at the end is being able to pay them out so that they can move on.
That's right. Yeah.
Okay. How do you structure the deal? Aurora says, how do you structure the deal when there's a realtor involved?
So I'm very blunt with my sellers right now. And I say the contract is between you and your realtor. So I'm happy to get involved, but generally I suggest that they speak directly with their realtor. Would their realtor accept a slightly decreased commission? So would they take $5,000 instead of $7,000 for their half? And sorry, I should backtrack there because I don't use a realtor. So they don't have to pay for the buyer's half of the fee there. And so I usually try to get the seller to work directly with their realtor first before I get involved, because technically it is their contract. And I just say, you know, we can work a number of different angles here. We can try a number of different things. You still have a contract with that realtor. They still deserve to be paid for the money they've put into it and the time they've put into it.
Yeah. Okay. Nice. So you kind of say deal with them on the actual contract, and then we'll deal with the kind of financing side of things separately from that.
Yeah, and a lot of sellers just don't realize that they have the ability to maybe negotiate a slightly lower fee from their realtor. So if it's only been listed for a week or two, the realtor still has fees. The realtor still has time invested in the property. I always suggest, you know, you need to pay them something for their efforts, but you have the ability to negotiate here, and let's see how we can make this a deal. And then if I have to, I get involved.
Perfect. And I'll just add to that too, Aurora, that there are realtors only in the investment space though that really do understand this. And some of them will even put together a deal for you that way and talk to their sellers that are wanting to sell and say, hey, would you be interested in doing an agreement for sale? They package it that way, and then they offer it out to their network. So if you want one of those realtors, we can definitely connect you. Just on a side point, I noticed in the background your hard hat.
Oh yeah.
So what does it say on it? Working partner?
Yeah, working partner. Yeah. I know everybody else does t-shirts, but I thought I'd do something a little weird.
I loved it because you really are. You're that get in there, get my hands dirty. I'm going to be right in the deal, in the trenches on your deals. So working partners, you would wear that when you're out at like events looking for joint venture partners, people to partner with you to finance some of these deals. Is that the idea?
Yeah, it's a new idea that just came out at the March Real Estate Investor Conference. And not too many people gave me dirty looks, so it'll probably stick around for a while.
Well, I loved it. It was amazing. Your picture made me so happy. Let's get to a couple of these questions. Yenga, how do you continue paying for the mortgage and other expenses if the seller continues to hold the mortgage?
So I have 2 bank accounts for each agreement for sale property. So one bank account can handle all of the regular transactions, and one bank account is shared with the seller so that they can see every month, every 2 weeks, whatever, that their mortgage is being paid. It's not always necessary. Some sellers don't care, but I offer it every single time as another full transparency. Here's a bank account. We're going to get it so that you can view only, but you can log in and view it anytime and see that this mortgage is being paid on time. You're fully up to date. Your credit is in good standing.
Because they really are taking a risk that, you know, they're handing over their credit to you basically. And if you don't pay the bill, you don't have really a consequence to that, but they certainly do.
Right, yes. And some people, the only reason that they're trying to sell creatively rather than foreclosure is they want to preserve that credit for down the road. Yeah.
Right. Perfect. So Dia says, so if the owners have to move out, so how do you handle them moving out, and do you split any profit with them?
No, it's not a profit splitting strategy is the word I'm looking for. So it's I need to get out or I'm going to go bankrupt. I need to get out or I'm going to kill my wife. I need to get out for some reason, right?
Yeah.
So no, there's generally no profit splitting with them. I'm solving some other problem for them. And usually they're so far in debt that profit is the farthest thing from their mind. They just want out of the bills.
Yeah. And the stress and the responsibility, right?
Yeah, for sure.
Awesome. So Calvin says, yeah, really good questions, you guys. So Calvin says, at what point does the vendor's name come off the title? And we're
Not an
behind here, so these might already have been answered, but we'll ask them anyway.
Oh, okay. So the seller's name stays on the title as long as the mortgage is in the seller's name as well. So those two concepts go together. When the deal matures at the end of the 5, 7, 10 years, then they come off mortgage, they come off title, and the title goes to whatever my solution was, my joint venture partner, my rent to own buyer, whatever my solution was.
Beautiful. Okay, awesome. And Corey asks, he's in the other room watching. So he asks, in that deal, and I'm going to assume he's talking about the couple where he was moving out of province, she was moving into an inherited property. How did they find you?
Well, to be honest, they tried a bunch of things. So they literally Googled and they called a bunch of people, and a bunch of other people said no. There wasn't enough instant equity in the deal for other potential buyers. And this particular deal has another problem where it doesn't actually have positive cash flow. So it's a zero money down deal for sure. It's a 5-year deal. They have no problem with that. It's seller financing, so it's got a lot of things going for it, but it doesn't have positive cash flow. So some people that they called first before they got down to my name on Google have just walked away from it. So they're super motivated for me. It's fantastic.
Right, because they've been rejected already a few times, and they feel like, wow, you're someone who's actually gonna take us on.
Right. So, I mean, their marriage is falling apart, their finances are falling apart. They already feel like a failure, and they're even being rejected by people who buy houses directly. So, just by, giving them a little bit of respect and engaging in the conversation, they're like literally open hearts, open everything. Like there's no secrets, no games, no nothing at this point. Is it a great deal for me? Well, not by today's numbers, but if I have it for 5 years, it's my choice, my consequences. So I don't know if it's all going to follow through at the end, but I'm still pursuing it.
Beautiful. And, that's what we talked about this last week. So we don't need to spend too much time on it, but it's still part of what I love about this strategy. And it's that you can be helping people, truly helping them. They need us as much as, some people say, oh, you're just a shark going after these poor people that are stuck. Well, they're stuck with expenses that they can't afford. They're stuck with, going to ruin their credit or going into foreclosure. You said something so powerful to me that I've thought about all week last week. You said, I didn't cause this situation. I didn't contribute to this situation. I would never want them in this situation, but I can perhaps help them in this situation. And that's where being a really good human, and how I love how you do this strategy, is you really are going out there trying to find something that's going to help them. And if not, you're willing to walk from it if it's not going to help them. So that's why I love how you are and who you are so much.
Well, thank you.
Okay, and I just want to throw a shout out. Just like us, we learned most things that we know from Barry McGuire. You too learned a lot of your agreement for sale strategies from Barry McGuire. He does have more information on it. I think we're going to run. I still have to talk to Donna. I didn't talk to her this week, which I should have. But we've been talking about it this winter, coming into the spring, of doing an event for joint venture stuff, which we specialize in, and agreement for sale stuff, which they specialize in. And maybe we'll do a virtual one, because since there's no events going on. But anyway, stay tuned for that, guys. I'll touch base with Donna this week and see if we can't get something going. Do a virtual event on creative financing of your deals, everything from raising money with joint venture partners to what Deb's talking about, agreements for sale. So let's hit a couple more questions. What do you think? How do you come up with an offer price?
It depends on a lot of things. So just like any offer, it's going to depend on location. It's going to depend on the condition of the house. In my city, it's going to depend on what community it's in. So some communities still are selling. There's not very many properties. There's still people buying. And some communities are really hard to sell in right now. And purchase price. So if you're in the 200 to 400 bracket versus the 600 to 800 bracket, depending on which price range you're in, I can get you closer to a listing price, fair market value. And it depends on the mortgage balance. I should be very clear about that too.
So really, at the end of the day, it's just like any other deal that you analyze. You put your numbers in, you figure out whether it's going to cash flow, not cash flow, whether you're going to rent it long term. I'll just throw this in there too. So for those that are thinking, well, why would you buy a negative cash flow property or one that doesn't, one that breaks even? When you're in the creative real estate space like Deb is, I can just see some of the scenarios that you might. So she might take, this house that it's got lots of potential. It's got lots of, it's in a great area. The mortgage is going to get paid down by a tenant for the next 5 years. There's lots of availability for her to benefit, but cash flow, not great. She can put a rent to own person in there, for example. Rent to own person is going to not only give her money down to move into that house, but then pay extra every single month, which could then be that gap, fill that gap for cash flow, correct?
For sure. And even if I have to support the cash flow for a year or two, when I crunch the numbers, so like I do my calculation, maybe I need to put in 10,000 into the property. It was a zero money down deal to start. Now I'm putting $10,000 in. In 5 years, maybe the way the numbers all shake out with the mortgage pay down, et cetera, maybe I have the ability to make 50,000 on the property. So would I spend 10 to make 50 over 5 years? Well, that's a question every investor would have to answer for themselves as to whether or not they would support a negative cash flowing property. But the big difference is there was zero money down on this one and there is no bank qualifying. So then it's up to me what I choose to do, really, whether I choose to support this property with some of my own cash.
Yeah, absolutely. And I know how you run your numbers. You are very, very diligent. You're so thorough. You remind me of Terry Berry. So, I know that for sure you've crunched those numbers, and it really does always come down to numbers. So are there sellers sometimes that you talk to, and I know the answer to this because we talked about it before, but that you can't help?
Yeah, for sure. So there's some sellers that, so I have one seller that very motivated gentleman, but he wanted to be paid extra interest on his mortgage, basically. So for the privilege of me using his name and his mortgage, he wanted me to continue paying him on a monthly basis. He was an investor, and so he knew his numbers very well, and he knew that by paying him this amount, it would no longer be cash flowing. So I did walk from that deal. It was a little too rich for me, for sure. And then there's some sellers that are just so far underwater, or something raises a red flag as an extra risk for me. So I think last week we talked about the seller where it was a beautiful property, beautiful location, but well over $100,000 in CRA liens or caveats or whatever on the property. And I don't want to put myself in between the seller and CRA because I'm not coming out ahead.
No one's going to win that one.
No, definitely not me.
For sure. Okay, awesome. So there are some times that you have to walk away. And I remember, so when we were doing this kind of strategies like this in our major buying stage, I remember that was really difficult for me because here I was putting out, flyers and signs and different things saying, I can help you, I can get rid of the stress for you. And for the most part, I could, but there were some that I couldn't. They were too far underwater. There were too many. Like, I remember the one. It was like there was 2 or 3, payday loan liens on the property, and it was just a mess. And there was a wife that wouldn't talk to me and wouldn't be involved in it, and I needed her consent. It was just, so I had to just walk, and he did have to foreclose and lose everything. So it was, sometimes you do have to just walk. So this isn't a strategy that works for everything, but it certainly is one that can help out them and give you that 5 to 7 year lead time that allows you to create the creativeness within there to create profit, even if there isn't any.
Yeah. And there's definitely a whole group of sellers out there that bought in Alberta again, that bought 2014, 2015, 2016 even, and they still believe in their minds that the house is worth what they bought it for, and at the very least they should get their down payment back. So I always get a realtor to run comparables for me. And with those sellers, I'll share the comparables. I'll say, look, here's what your next door neighbor's house sold for back in February or whatever. Yeah. And so I can't actually give them what they believe fair market value is. I can only give them today's fair market value.
Yeah. And that's sometimes very different, isn't it?
Oh yeah, I have to walk from most of those deals because I can't overpay in this economy.
Yeah, no, you can't. You can't take that risk on because there is risk.
Yep.
Yeah, you're taking over their problems, and that's why they're paying you to do it.
That's right.
Yeah, it certainly is. Tina asks, so how do you structure it if the seller wants to stay in? Do you ever do that?
No. But that's not based on my experience. It's based on way smarter people than me that have tried it before and never had success with it. So if somebody who has like dozens of properties is telling me this won't work, I just listen and I just don't do it.
Brilliant, right? Why recreate the wheel if someone else has tried it and say it's not been my best experiences? Yeah. Okay, good. Sylvie says, what payout do you have to provide upon possession?
It depends. You can negotiate anything. So how much money does the seller need to get out? That's a very different number than how much money does the seller want to get out. So it totally depends. If they have no equity, like the house I'm working on now, I'm not paying them anything. And I might pay their their legal fees. So I did that on a property last summer. They had 0 equity. They didn't pay me anything. I didn't pay them anything, but I paid basically their legal fees. And then of course there's the tax adjustment.
Yes, for sure. Okay, so we got a couple more questions. So Sylvia, a lot of times it can be no money down or very little money down. Sometimes they just need enough money to move on to their next place or to move to the next province or whatever it might be. So Julie, so how and when do you set the sale price? The beginning of 5 years or market value at the end of 5 years?
Oh, that's a great question. Yep.
Right.
So some sellers ask me that a lot. So it's based on today's market value because none of us has a crystal ball about what's going to happen in 5 years. So we take on today's mortgage balance and we take it at a price comparable for today's market value or a little bit less.
I can see that being a nice thing to say when you're dealing with those vendors one-on-one. So we're taking over your mortgage at today's, value, the high value. And so we'll take on, the price, the sale price at today's value as well. That seems to make sense.
I'll just add one thing there. So one of the things that I do talk to my realtors about is when they are doing regular real estate deals, how close to today's list price are they getting? So is the average offer only 10,000 below today's list price, because maybe that's a reasonable offer for me to make as well. So I do try to keep in touch with, okay, if you were to, and I try to compare, if you were to sell it regular price, regular market, use a realtor, what number would you get? And I try to walk them through. So let's say, for example, they list their house for 400, maybe they would get an offer for 380. And then they would have realtor fees on top of that. So they would actually be coming away with, let's say, 365, just for lazy math.
Yep, for sure. So and when you break it down to a seller and show them that, it makes what you're offering even more attractive, right?
Yeah, because I'm showing them, okay, so if your mortgage balance is 370 and you were going to walk away with 365 if you sold it for a realtor, then by me buying it for 370, you're actually getting $5,000 more than you would if you sold it with a realtor.
Yeah, perfect. And I can just see you talking to them so calmly and confidently, and that really does help. But I know that came with a lot of practice, right? That came with a lot of not failed deals, but deals that didn't go through. Yeah. And that's the only way, by seeing these things over and over again, do we have that calmness about us, hey?
Oh, for sure. Yeah. They're anxious. And so at the first few deals that I was working on, I totally picked up on that anxiety, and I'm started questioning myself. But more and more after I started talking to these different sellers, you get more confident in, actually, I do know my numbers. So here's what I can offer you. Here's how I can help you. I can't be your fairy godmother. I can't fix some of the problems, but maybe we can do this house deal.
Yeah, I love that. I can't fix your problems, but let's do a house deal. This is separate from your problems. You just have such a great way. So legally, the owners give up possession and ownership, or just possession? So next month they would give up possession, and then in 5 or 7 years they would give up the ownership of it. They would own it for that time period. Yes?
Yes. So I am not a lawyer, but there is a real thing that I can point you in the direction of. So there is such a thing with real estate as legal ownership and beneficial ownership. So with an agreement for sale, when I get possession of that house, I have 100% beneficial ownership. I'm not a lawyer, so I can't really explain that, but my way of explaining it to myself is that I have the risks and benefits associated with the house as of the closing in 5 years. Beautiful.
Yeah, I love that. Love it. Terry says, what if they only have 2 years left on their mortgage? I assume she's asking.
Yep, good question. So the term can be anything. It can have the term that I buy for, I shoot for 5 to 7 years. If their term on their mortgage is only 2 years, then we write it right into the contract that they will renew it for another 3 years. And literally that is the only task that they will have to do with the house over the 5 years that they stay on mortgage and on title. And so oftentimes, your mortgage comes to you, you can click yes on whatever, or mail back, or whatever it is. It's usually something very simple, but it is written right into the contract that yes, they will renew their mortgage.
Beautiful. George says, Deb, do you have to inform whoever's holding the mortgage? So the mortgage company.
Right. So I take a cautious approach to that. There is a risk with agreement for sale that the bank can say that it's sold as of the day that I take possession. And they could, in theory, call that mortgage on that day and say, okay, well, technically you sold it. Okay, pay up.
Really?
Yeah. That's a Barry Maguire. It's one of those key lessons from Barry Maguire.
Good old Uncle Barry's always got our back.
Yeah. So would they actually do that? I don't know. Generally, what we do is try not to rock the boat. I will take on all the payments. I'll even put the payments into my account. If the bank doesn't like that, we'll put it into a shared account. So we are cautious with banks because like we're already half an hour into this, 45 minutes. So Susie Q that just started at the bank 6 months ago is not going to understand agreement for sale. And so the risk is that I start talking to whoever the mortgage provider is. They have very little experience. They don't understand. And they say, sounds sold to me.
Right. Yeah. So just to kind of be really clear, the only real thing you'd have to do with the lender is just say, hey, can you stop taking it out of this bank account, the mortgage payment, and start taking it out of this bank account?
Right. Yes.
Yeah. And that's really all that they need to know.
Right. So, and technically, it's not considered mortgage fraud because the seller is still on title, they're still on mortgage, they're protected with the legal ownership. And so we are making the payments on behalf of the seller as part of our agreement.
Yeah, perfect. And just so you know, there are some creative people will call it real estate, things that you can do, that are illegal and is mortgage fraud. Neither us, and for any of you guys that know us, that's a huge thing for us. Don't play in gray areas. There's no point. There's so much money to be made in black and white, beautiful areas. Deb would never engage in any of that. I know she wouldn't. She's so strong ethically. And the guy, the lawyer that teaches these kinds of things would never advocate for it if there's any gray area. He always just says, like, why? And he's been around for 40 years teaching this stuff. So yeah. So you got lots of thank yous, and we love that. Let me see here. Someone says, I remember that hat from Rainacre.
Yep, that was the debut.
Oh, so good. Because in Ignited, we teach you to do, t-shirts and get out there and whatever. And then you show up in this like worker outfit, like I'm in the trenches. Oh, I seriously loved it so much. Corey says, I love how you so clearly communicate, Deb.
Oh, thank you.
So Yenga, yes. So they would change bank accounts for sure. They're saying, thank you. This is so valuable. So you profit out of this deal when there is no positive cash flow. That was 17 minutes ago. So I think absolutely. We've covered that. Deb, do you have an agreement with husband and wife?
Who's on title? So it depends on who's on title. So if they're both on title, they're both on the agreement for sale. If only one of them is on title, so in some cultures that's more common, then we have to sort out the dower rights of the other partner, typically the wife, but not always.
Typically the wife, but not always.
I'm starting to see some other couples out there. Yeah. Yeah, for sure.
Okay. So it sounds like, yeah, I love that answer, that it would make sense that it's whoever's on title you'd have to deal with. But if there was a significant other that lived in that home, they may have a legal right to that as well. And you would have to deal with that through lawyers as well.
That's right. So the gray zone comes occasionally when people are common law, and then I have to defer to my lawyer because I'm not an expert in those issues.
For sure. Yeah. And you're such a great example of that. We don't have to know all the answers. We just have to have a team member that does.
Oh, for sure. Right. Yeah.
Yeah. Andrea says, what kind of reserves and practices do you recommend that an investor have before taking on a deal like that?
Oh, good question. Yeah. So your closing costs, like know what those numbers are going to be, know what your approximate tax payments are going to be. Your lawyer fees for an agreement for sale are a little bit more than what you would normally have for a regular sale and purchase. So regular sale and purchase, let's say it's roughly $1,200 to $1,500. Agreement for sale, you might be looking at $2,500 to $3,000 because there's a few complexities in that one extra piece of paperwork that make it more work for the lawyer and his assistants or her assistants, pardon me.
Yeah, for sure. Okay, so that's the closing costs. Do you then have a reserve for that property?
Always. So
I know.
I have a big sleep at night fund usually. I usually like a significant amount sitting there minimum, because what if it takes us a few months to get it rented? What if the hot water tank goes on day 2? What if there's hail damage and I have to pay for repairs before the insurance company does something? So it depends on the property, the size of the property, the location, how old it is, as to how big my reserve fund is. But I would always, always have one, and it would almost always be a minimum of 3 months of, rent and expenses, both for the property.
Yeah. Awesome. So I just want to take a moment too to kind of talk a little bit what we talked about last week was the beauty of having motivated sellers coming to you. For one, is they've already the onus is on them to reach out. They're asking you for help. Now, the thing is that, like, I learned this from the first time talking to you when we did our one-on-one call when you joined Ignited, was you had this deal and you were like, you know what, it's a great deal. It's no money down. It's no bank qualifying, blah, blah, blah. That deal, I don't know if you ended up doing it, but your plan was, you know what, yeah, I can assign it. And it was a cash flowing property that you could assign to another investor. You could wholesale it out. We talked about this already. You can put a rent to own tenant in it. You could bring a joint venture partner in. So let's stop and talk about that. So let's say that you have this property and your plan for it was to bring a joint venture partner in on this deal rather than just keeping it for yourself. How would you structure that?
So the joint venture agreement is separate. So just like any time you do joint venture agreement, you do your letter of intent, you'd explain the strategy to the seller, explain the risks and the rewards to the joint venture partner, so that they know fully what they're getting in for as well. And then we can put a caveat on the property. So there would already be a caveat for the agreement for sale showing the beneficial ownership. And then there can also be another caveat protecting the joint venture partner on that property.
Beautiful. So if let's say that this, you talked about this one scenario, but there's been many more I know over the last few weeks even. So let's say that there is cash flow, there is mortgage pay down. Now, do you split that with your joint venture partners?
Yeah, it's just like any joint venture agreement. We can set it up any way that they want. Typically, I'm doing way more work at the upfront, and typically for a joint venture partner, it's under $50,000 to get into the deal, often under $20,000. So oftentimes, the joint venture partner might only be putting up basically my reserve fund, and then they can come in on the deal with me.
And they're gaining half the equity, and they don't have to qualify.
And they don't have any work typically. Yep.
Good deal. I like it.
Yeah.
Let's see. I'm like way behind in these questions. Let me see here. It would be really helpful to see numbers for a few sample deals and scenarios for sure, Grant. Grant is very detail oriented too. Yes, and Deb did actually send us some, but again, it's just, there's no way we can get through it all. It's craziness, but yes, for sure, it would be really helpful to see. And the thing is, they vary so much too. That is actually where it comes into doing that event. If we were to do an event with Barry and Donna, we could squeeze them for numbers, and they're always good for analyzing a deal, right?
And they bring in experts that have done like 50, 60, 100 agreement for sales. So they can talk numbers like in circles around me. But they, like Barry and Donna, bring in some very real world examples, like actual contracts that they've seen. And they have a hands-on portion usually of their courses where you can say, okay, pretend you're the seller, pretend you're the buyer. How would you structure this? And then you literally walk through the paperwork together and walk through the numbers together. It's really, it makes all the difference. Yeah.
For sure. And I'm just seeing now, I'm kind of scrolling back and people are like, yes, let's do that event. Let's do that event. So yes, I will get on that. I'm so bad. Yeah, anyways. Okay, Simon says, how long does it generally take you to analyze the deal? I'm concerned about analysis paralysis or over analyzing the deal, depending on what you're deciding to do. So how long typically does it take you, Deb?
So right now I have the luxury of time because really I'm in the driver's seat. But typically when you're dealing with a motivated seller, they're not just talking to you, they're talking to 5 people. Whoever comes up with the best deal the fastest is who they're going to do business with. So typically I try to be as efficient as I can. And honestly, my first few deals, I was like, okay, what button, where, which website? So I've gotten a lot faster of, okay, let's pull title. Let's see if there's anything weird there. Let's get the realtor to pull comparables. Let's see if the value that the seller thinks is there. Because these are ways where, I might spend $10 to pull title and say, okay, I'm out of this deal. And I can get back to the seller very quickly and explain, no, I'm sorry, I'm not able to move forward now. But generally within 24 hours or less, I've already made a decision about whether or not this deal is worth writing an offer on. That's all that I need to do to move forward. And then in my offer, I give myself a condition, usually for lawyer's approval or something else. I give myself a way that I can get out of it if something fishy turns up and I no longer feel good about the deal.
Nice. Yeah. So that's a great point too. All you have to do is decide whether or not it's worth you looking into more. And if it is, you can place that offer and then you have your time to do your due diligence on that at that point.
That's right. Yeah.
Makes so much sense. Yeah. There's something you said that I was going to say something to, but anyways, we'll move on. Okay, Sylvie, you say we're about to put together a VTB. Our original intention for today was to talk both about VTBs and AFS. We never got to the VTBs. So we will definitely put together another training on VTBs, because that's another thing that you're definitely going to see more is, like you said, motivated sellers that basically don't have any equity in their home. They can't even pay a realtor. They don't want to ruin their credit or go into foreclosure. They need another option. And VTBs, we've seen through the years, the tougher the times get, the more VTBs are accepted and a win for us. So Sylvie will definitely talk about that. But you can also throw that in for a laser session and we can work through that with you. Being an Ignited member, you can just throw that in and we'll work through it. So you don't have to wait till the next training. Let me see, just to see if I can get, why should they review their mortgage? So I think that's going back to when we were talking about if they only had a 2-year term and the deal's for 7 years.
Right. So it's written right into the contract. So once the deal is signed and done, it's not negotiable anymore. So they've signed a contract basically that says that they will renew their mortgage to a total of 5 years. I might put a rent to own buyer in there. 2 years into the deal, their term is up. I might only need 1 more year for my rent to own buyer. So I might say, all I really need you to do is renew it for 1 more year. Then they're out early. Yeah,
it's great. George says, with that scenario with the 2 years left, what if in year 3 their circumstances are that they aren't able to qualify?
So typically mortgages, the banks will still renew it. It's not a requalification situation. So yes, that would be, otherwise if the bank is pulling the mortgage for some reason, that would be a risk that I would be taking on, and I would have to come up with a solution, a joint venture partner again, selling it, whatever my solution might be.
Yeah, we're really just being paid to take on their problems, really.
Yep, for sure.
Yeah. Okay, do you get involved in mediating if 2 selling parties are on kind of having different expectations, as Simon puts it?
So that's one of the things that would make me say this deal has way too much potential to go sideways. You know what? If you guys are on the same page, I'd be happy to help you out if your lawyers can mediate an agreement. Because if they're like in that serious divorce situation, that it's a problem, then if the lawyers can coordinate a solution, we'll do it. Otherwise, it's too complicated and too much risk to me in the divorce agreement.
Yeah, a lot of times it's not just about the numbers, it's also about the situation and the emotion, time, energy that you're going to have to put into it. And yeah.
I think that was the biggest learning for me, is it's not always about the money for the sellers. It could be about anything else. So one lady I did a deal with, it was literally about the stairs in her house. She could have cared less about price.
Right?
Yeah.
What about the stairs?
Well, her husband was sick, so she needed to move to a cute little 2-bedroom condo with 0 stairs.
Okay. Yeah. Right.
Yep.
Yeah. It's about finding, it's just like with our joint venture partners. We listen to them to find out what it is that they need. And then we, figure out if we can provide that for them. And if we can, we have a win.
Yeah.
Super interesting. I'm just going to read you some of these. Now we got to wrap up here just because we're at an hour already, if you can believe it. I've been so many times listening to all this stuff that says your show should be like 17 to 25 minutes. And I'm just like, that's the recommendations for podcasts and stuff. I'm like, how do you offer value in that time? But anyways, you're doing amazing, Deb. Thank you so much, Deb. This is so awesome. Thank you. Great job. You're so clear, so valuable. Thank you for stepping out of your comfort zone. Thank you for sharing your wisdom. This is so great. Thank you. It's awesome and helpful. Very helpful. Thank you, Deb. Yeah, so much love. So well deserved. Thank you as well. I thank you as well, because I know that this is tough for you. Although it doesn't look like it, you don't seem like it at all, but you're not the kind of center of attention person. So, but you know what? You're absolutely doing that. Oh, is there a dog waving his tail in the shadow? Yes.
Yes.
I saw that too. Okay. So I think that we should probably oh man, there's so many questions there. Oh no, there's only 2 more. Okay. Let's hit these 2 more. All right. Do people typically stay in after a general 5-year JV agreement? Do the exit strategy lend more to exit or staying in? So after a 5-year agreement on a agreement for sale, I think is the question. Do people typically stay in?
That's a good question. So I've only been doing this for 5 years and I've really only been pursuing agreement for sales aggressively for 1. So I don't know if those joint venture partners on the agreement for sale would want to qualify on the same property that they've already owned and profited on 5 years from now. I honestly don't know. They'd probably be getting in at 60 to 70% loan to value rather than 80% loan to value. It could make good sense. Who knows what the economy will do then?
Yeah, just a wait and see, right?
Yep.
And, lots of our joint venture agreements, our first plans were to go in for 5 years, and 17 years later, we still have them. So,
right.
If the deal is working for some, they just continue it. And for others, they've gotten out when the deal ended and a little bit past it, actually. Most stayed in a little longer, but yeah, anyways, you have got so much love coming in for you. So I hope you can go back in and read all the comments just to confirm that, yeah, you are a great human. You do rock. We love you very much. We're so proud to have you in Ignited, that you're that good person that is really trying to help not only other investors, but people out there that are, you're just an open book in helping people. So thank you for that. Thanks for your wisdom. Can't say how much I appreciate it. So, and guys, if you're, looking at some joint venturing, clearly Deb is an amazing partner. There's no, hands down, there's just no way around it. She's a fantastic partner for you. So if you're looking for a hands-off investment, I think you might have found someone. So
thanks very much.
Yeah, thanks again for all your wisdom, and we'll see you over in Ignited. You're going to jump over with us?
Oh yeah, for sure. Thank you.
Awesome. Cheers. Have a good one. Thanks again.